Good afternoon, I'm Jennifer Christian and I work as a portfolio specialist in the investment management team, and I'm going to provide you with a brief overview of this week's market summary. In a week that seemed primed to be dominated by central bank meetings and policy, in particular by the US Federal Reserve, it ended up being hijacked by none other than US President Donald Trump. In a quiet few months for trade and several stalemates in trade negotiations with the Chinese, on Thursday Trump announced a surprise further 10% of tariffs on Chinese goods. These tariffs are due to come into play on the 1st of September, with Trump stating that the tariffs could go well beyond 25%. The Chinese have since pledged countermeasures, which the market awaits. This has all come after a set of two-day trade negotiations between the two countries, which ended with little progress. Now, we have seen this type of posturing before from Donald Trump in order to put pressure on the Chinese to reach an agreement. And with a date for the tariffs to come into effect after the trade talks in August, the current pullback in equity markets seems an overreaction, and if anything, could represent a buying opportunity ahead of further trade talks. As we have seen at several points this year alone, the market can severely react to short-term news, which allows for great investment opportunities. Trade aside, this week has been littered with central bank meetings, with all eyes centred on the Fed. Whilst there was mixed expectations on the level of the cut, the Wednesday meeting saw the announcement of a small cut of 0.25%, which disappointed markets initially. However, following the cut, Jay Powell announced the potential for a further handful of mini rate cuts. The Fed's approach seems sensible for the economy, and whilst Donald Trump thought Powell was too hawkish in his approach, it allows the Fed more room for manoeuvre going into 2020, which is ultimately better for both US and global equity markets. On Thursday, we also saw the Bank of England hold rates at 0.75%. This came after a drop in sterling following the Fed policy meeting a day earlier. Bank of England Governor Mark Carney went on to reduce the bank's 2019-20 growth forecast for the UK economy to 1.3%, citing uncertainty around Brexit as the protagonist, whilst also keeping the possibility for an increase and cut in interest rates on the table. This stance suggests that the outcome of Brexit is not a foregone conclusion and that the bank remains accommodative and data-dependent. Carney's comments on Brexit uncertainty comes a day after the UK Chancellor pledged £2.1 billion to prepare for a no-deal Brexit. Now, whilst this does seem quite an extreme measure, it seems likely that this was a move designed to show Brussels that the UK was prepared to leave the EU with no deal rather than a bad deal. There was also a suite of economic data released, with arguably the most significant being US employment figures that saw the headline unemployment rate remain unchanged, whilst the participation rate increased, suggesting a tightening in the labour market. We also saw Chinese manufacturing data beat prior numbers and expectations. European unemployment remained steady at its decade low of 7.5%, and European GDP beat expectations, coming in at 1.1% year on year. Now, that's all from me this week, and don't forget, if you haven't already, you can also read a more detailed insight into matters affecting the markets in the email.